Good morning, everyone. Uh, are you able to see my screen? Are you able to see my screen? Hello? Hello, are you able to see my screen? Can we start now? So, very good morning to everyone. Today, we are going to cover the second part of financial statement analysis. Yesterday, we covered about comparative financial statements, common size financial statements, and trend analysis and ratio analysis. That is first part of our financial statement analysis. And the second part today, we are going to cover uh, another tools that are used for the purpose of financial statement analysis. That is cash flow statement, fund flow statement, and cash flow statement. So first, let us go through what is meant by funds flow analysis, or what is the purpose of preparing a funds flow statement and how a funds flow statement can be prepared. So this in this unit, we are going to discuss about what is meant by the concept of a fund, what is meant by the flow of fund, meaning of a funds flow statement, and the preparation of the funds flow statement. Fund. What is meant by fund? See, all the business transactions are executed in the form of cash, but the cash will not the physical form of cash will be in different forms. That is, it is existing in the form of assets and it is existing in the form of liability. That is about how we are using the cash that we are receiving from the shareholders or from the outsider liabilities. So when we are talking about the fund, we are talking about how different by taking into consideration the uses of the cash in the form of assets and liabilities. How we are utilizing the cash by creating assets and by raising the liabilities. So it is broader concept than cash. So it's not alone about individual component of the cash. It is about various forms of cash. Cash will exist in different forms in the form of assets and liabilities. So in the funds flow statements, in the funds flow analysis, what we try to do is how the cash is moving between different assets and different liabilities. So this is the movement of a fund. So there are different views and opinions about what is meant by a fund, but basically the fund constitute the cash in all forms, not a cash alone, but it constitutes all forms of the cash. So what is meant by movement? So in funds flow statement, what we basically do is we will try to understand the movement of cash and cash flows in the form of a working capital. So how whatever the cash transactions that are taking place, that will be affected through the working capital, because working capital composed of the main component cash. So everything should be done through the cash. So hence, in the funds flow statement, the flow of funds can be done with the help of with using the working capital concept. So the movement of funds in the form of the assets or liabilities, whether it is long term or whether it is a short term liability, it will be reflected in the working capital. So we will try to understand how the cash flows are moving in the form of working capital. Here the cash flow means, it means change in the funds, whether the cash component is increasing or whether the cash component is decreasing. So this we will study in the form of changing in the, this we will study in the form of how it will affect the working capital. So then let us understand what is a funds flow statement. A funds flow statement gives us an idea about from different source, from where the funds has been rising from different sources in different ways. So we may not be getting cash in the form of shareholders or so all those sources from where the funds are rising, we will understand, and the application of the sources from where we are applying this. So from where we are applying these sources can be understood. So based on this, we will try to understand how the company is managing its resources and how it is utilizing its resources. So it also gives an idea about how much amount of the funds that a company has raised during an accounting period. So from internal sources and from the external sources, so that it will give you an idea about what kind of whether we are doing well or in terms of utilizing the funds, or whether we are misusing the funds, or they have been effectively utilized. So this area can be understood with the help of a funds flow statement. It will, as we already discussed, it will give us an idea about how much volume of funds has been generated during two balance sheet items, and various sources and applications of funds can be understood, and we can categorize the sources and application of the funds into different forms like operating activities, financial activities, and investing activities. The cash funds flow statements also will help to make projections. When you are when you are preparing a funds flow statement for a long period of time, say for example for 3 4 years, this will help us to understand to what can be the future scenario regarding the sources and application of funds. This is the importance of funds flow statement. And now let us understand some of the limitations of the funds flow statement. See, the funds flow statement did not give any explanations for the sake of it. It will broadly gives you an idea about how the funds are moving, how various sources of funds are moving. But in what context the funds has been raised, in what context that the fund has been utilized, that context cannot be understood. That is the qualitative information. The purpose of decision making taken by the management cannot be reflected in the funds flow statement. And other thing is that the funds flow statement may be affected by the limitations of preparation of the financial statements. So financial statements are prepared based on the assumptions. As we already know that financial statements are sometimes subjective with respect to the interpretation of accounting principles and concepts. So as a result of this, the analysis of funds flows may be affected by the subjectivity concept also. That means, as we already know, that it may not give proper explanations for why a fund has been utilized, why it has been from certain sources a fund has been raised. So this type of information may not be revealed from the funds flow statement. And one more thing is that this is different from income statement and balance sheet. Basically, income statement gives you a picture about how much amount of revenue that we generated in the financial year, and the balance sheet gives you the static position of assets and liabilities. So there is a continuous flow of money in this in the business transaction that can be reflected in the form of income statement and the balance sheet. So that flow cannot be reflected in the income statement or in the balance sheet. To understand that flow, we will prepare the funds flow statement. So this funds flow statement gives you an idea about how the revenues are generated, how the expenses are incurred, how assets have been raised, how liabilities has been created. That can be understood from the funds flow statement. So it is different from an income statement and a balance sheet. It only provides some additional information regarding the changes in the working capital. So whatever the information given in the financial statement, it will summarize and gives a picture about how the funds has been moved between different items. But it doesn't give any, it doesn't give any new information. It only gives the what was actually happened, and what we presented in the income statement and balance sheet can be understood with the help of a funds flow statement. So it will give a picture about changes in the working capital position to a particular point of time. So this is briefly about fund flow statement. So how to prepare a funds flow statement? So what are the components of a funds flow statement? So funds flow statement can be prepared in 4 steps. So for example, we will be given a balance sheet, or we will give some additional information regarding what are various activities, some adjustment regarding the assets and liabilities. So in the first case, we have to understand what is the actual change in the working capital position of the company. So we have to prepare a statement of changes in working capital position. This is the first step in the process of funds flow, preparation of funds flow statement. Then afterwards, we have to look at adjustments given for various individual non-current assets and non-current liabilities. So we understand the changes in the current assets and current liabilities position using the statement of changes in the working capital position. And after doing that, we have to make adjustments for the non-current assets and non-current liabilities based on the information given in the problem. And after doing that, we have to calculate the adjusted profit and loss account to calculate funds from operations. So see, This is the third step we have to follow in the process of preparing the funds flow statement. So in the first step, we will understand what is the actual changes in the working capital. And in the second step, we will understand what are various non-current funds, non-current assets, and what are various sources and applications of funds with respect to non-current assets and liabilities. And in the third step, we will understand what adjustments for, we will make adjustments for non-current, non-operating expenses. So non-fund expenditures. So we will make adjustments in the profit and loss account adjustment account. So after taking these adjustments, we will prepare a funds flow statement in the fourth stage of the preparation of funds flow statement. Let us understand the components of a statement of working capital. See, the first step in the process of preparing a funds flow statement is the preparation of changes in working capital flow. For that, we have to follow. Here you see current assets and various current assets and various current liabilities are given. So we have to take the figures of previous year on one side, and we have to take the figures of current assets and liabilities of current year on the other side. Then we have to look at the difference between previous year and the current year. If a current asset increases during a current year, then we have to consider that current working capital has been increased. That will happen with respect to cash in hand, debtors, bills receivable, accrued income, prepaid expenses, and any other short-term investment. So all this can be reflected in the form of increase or decrease in the working capital. This we will see in further. We will see a problem. We will understand this. Just understand this. Before that, you try to understand. And with respect to current liabilities, the same thing we can follow. We will incorporate the figures of previous year and current year, and we will try to understand the increase or decrease in the working capital. And overall, we will try to see on a whole whether the working capital has been increased or decreased. This is the first stage in the process of preparing funds flow statement. In the second stage, I already told that we have to make adjustments for non-current assets and non-current liabilities, that is fixed assets or long-term assets, whether the funds has been raised or whether the funds has been utilized. After preparing that, we have to make adjustments for non-fund and non-operating expenses. See, as we follow this accrual principle of accounting, the profit what we calculated for the period also includes some non-cash expenditures and non-operating expenses also. So that we have to exclude for the purpose of calculating funds from operations. The funds from operations statement gives you an idea about what actual amount of funds that were generated during the year. That is the actual amount of cash that is generated from the operations. Operations means from your regular business activity. So we have to understand that how much we have generated during a period from our regular operations. So this can be calculated using this format. Here we will take net profit of the current year, and we will make adjustments for goodwill written off, proposed dividends, loss on sale of fixed assets, depreciation, discount on debentures written off, and provision for taxes. All these are non-fund. Non-fund means that we are not utilizing the cash here actually, and some of them are non-operating. They are not related to our regular business activity. So what we will do is, see for example, goodwill written off is not a cash expenditure. It is a non-cash expenditure, and at the same time, loss on sale of fixed asset is not a regular loss that we will incur in the business. It is an extraordinary item. So it will happen some or other time. So such type of here also we don't lose any cash as such from the profits, but for the purpose of accounting we will show it. So what we will do here is that such type of expenses what we have deleted we will add to the profit of the current year. Then we can deduct the profits which are non-operating income. See, other than regular income, see from the sale of goods or services or from fees or from any other commissions, whatever we receive, this is the regular income. Other than that regular income, we will receive some ad hoc incomes like profit on sale of fixed assets, income from investments. Sometimes income tax refunds will become. These are all not regular operating income. So what all we do is these are all will be there in the profit. So what we will do is we will deduct these expenses from these incomes from the net profit. So that we will get after making adjustments for this non-fund and non-operating expenses and non-operating incomes, we will understand what is the actual cash flow that we have derived from our operations. Operations are the regular business activity. So this is the third stage in the process of preparing our funds flow statement. Okay. Now, see, this is the final statement, final format of funds flow statement. So as we already understand that in the first stage, we will understand what is the actual changes in the working capital position so that we can show as it up. So if working capital is increased, we can say that we are utilizing the funds. If working capital is decreased, that we are saying, so it is creating sources of funds. That means more liabilities will be there. So other sources of funds. See, for example, issue of shares may be there. We may be issuing debentures of the. We may be issuing debentures. There may be sales of fixed assets. There may be loan from borrowings. There may be investments which we were sold during the year and funds from operations. So normally what we have is net profit will show all these things. But what we are doing is we are doing a reverse of things. See, we calculated funds from operation by deducting all those things. Again, we are showing it separately. That means we are doing a uh, detailed analysis of what we are presenting in the summarized from the financial statement or profit and loss account or the balance sheet. And some of the applications is that we can repay the loans and we can repay the shares and we can redeem the debentures. We can also purchase debentures. We can pay tax and we can also pay dividends. And sometimes there may be losses from the operations also. There may be negative cash flow also may be there in the operations. So these are the four steps, and these are the basic formats for working cap statement of changes in working capital and funds from operations and the funds flow statement. Okay, this is briefly about the funds flow statement. Now, everybody have an idea right now what is meant by a funds flow statement and what is the process of funds flow statement. So now what we will do is let us go for a problem. So let us try to understand how to solve a funds flow statement problem with the process that we have discussed now. See, I will share you a problem with you now. Let us try to discuss one problem so that we will understand the process of preparing a funds flow statement. So, hope that you are all seeing this problem now. I think everybody is seeing it. Can you see the problem now? Are you able to see the problem?
Yes, sir.
Yeah, yeah. So this is the balance sheet that we will be given for the purpose of calculating the funds flow statement. See, we'll see assets or the application of the funds. So that is, equities and liabilities will give you the information regarding how various sources, source various sources of funds, in which form we will raise the funds. All this gives you an idea about the sources from which the funds has been raised. And the asset sides will give you the application of funds, how we are utilizing the funds that we generated in the form of equities or liabilities. As we already know that a company doesn't own anything on its own, all assets and liabilities at any particular point of time will be balanced. So now what is the purpose of funds flow analysis? See, here there are various sources of funds in the form of equities and liabilities, and there are various forms of assets that we have utilized that based on the funds we receive. Now we have to understand what amount of funds that has been raised from each component. So, for example, share capital. For example, proposed dividend. For example, trade invest. How the cash has been moved between all these items. Though they doesn't show the actual form of cash. They are the form of cash. So they will be represented in the form of cash. So, first, what we have to do is we have to prepare the statement of changes in the working capital. We already have a format. We discussed the format. And here we have the current assets like debtors, bills receivables, bank, and stock. So for 2023, end of the 2023, the debtors value is 3 lakhs rupees and bills receivable value is 1 lakh 50,000. Bank is 1 lakh 35,000, 1 lakh 30,000, sorry, and stock is 59,000. And same, see here here one adjustment is there with respect to the stock. I will tell you. In the balance sheet, they did not give you the stock. They gave an adjustment for the stock. What they are saying that initially they measure the stock at some 59,000, which is less than its original cost. But now what they decided is they decided to value it at the original cost. So as far as the original cost, it is 1,25,000. So there was an adjustment for the stock that was not given in the balance sheet. Normally, stock will be given in the balance sheet, and we have to consider it as a current asset. But whereas here they gave an adjustment, so that we have to make a change for this adjustment. So we will take this opening and closing stock as a current asset here first. This is one adjustment. We have to make other adjustment for it in the revenues, funds from operations. Why I will tell you. Why I will tell you, because we will consider closing stock while calculating the revenues from the operation. Whereas in this case, we are not considering it. We did not take stock in the balance. We did not take stock in the balance sheet. So we have to make the change for this adjustment in the funds from operations. So it will increase the funds from operations. So we have to add this in the funds from operations statement. So this point we have to remember while preparing the funds from statement. So now after identifying the differences between current assets and liabilities, we see debtors. Debtors has been decreased and the bills receivable has been decreased. We can see that bank balance has been increased and the stock has been increased. So this is about current assets position. And then come to the current liability. So liabilities for goods and services is nothing but sundry creditors, and we have to take provision for taxation also as a current assets. Or then may see sundry creditors has been decreased and provision for taxation has been increased. Provision for taxation has been decreased. Sorry, decreased. So this has decreased, showing that. Then you can see that total current assets is 3 lakhs 10,000 and total current liabilities for 2024 is 3 lakhs 15,000. So when we take the difference between current assets and current liabilities, we can see that there was an increase in the working capital position. So the working capital position has been increased to, the working capital position has been increased by 11,000 rupees. 11,000 rupees. So with this, we will calculate the statement of changes in the working capital position. After doing this, what we have to do is, we have to, after doing this, what we have to do is, we have to calculate the adjustment entries. Adjustment entries. So the what we have to look for what are the changes made in non-current assets and non-current liabilities. Here we have one adjustment for the machinery sold. What is the adjustment is that one machinery costing 35,000 has been sold for 94,000 and a depreciation has been provided at 45,000 and the depreciation has been provided at 45,000. So we have to make an adjustment for this, and out of this we have to understand whether the cash has been inflown or whether the cash has been outflown from the by the sale or purchase of machinery. So the fixed assets balance shows that 9 lakhs and 11 lakhs during the year. Let us take this. See, this is the opening balance and this is the closing balance. So during the year, what we did is we sold a machinery costing 35,000. So that is 35,000. By sale, we are showing it as 35,000. And on this, we had incurred a depreciation of we had incurred a depreciation of 45,000. Then what happened is, let us see. So the actual cost of this machinery is 94,000 and the depreciation incurred on this machinery is 45,000. So therefore the cost of the machinery will be 49,000. This whatever this is costing 49,000, but it was sold for 35,000. So what is happening is that we are incurring a loss of 14,000 on this. We are incurring a loss of 14,000 on this machinery sale. So that loss can be transferred to profit and loss account, profit and loss adjustment account. So after making these changes, the total will be 11,94,000. And while making the balance, we can see that we purchased an additional machinery of or additional fixed assets of 2,94,000. So all these things we have to make in the whatever we purchased, whatever we sold can be shown as an application or sources of funds in the funds flow statement. Then we calculated a depreciation. But we are not directly deducting this depreciation from the profit and loss account. Instead, what we are doing is we are creating a provision from this depreciation account. So let us see. We have an accumulated depreciation account given in the problem as 2,80,000 and 3,40,000. 2,80,000 is the opening balance, 3,40,000 is the closing balance, and accumulated depreciation during the year is on this machinery is 45,000. So after taking the difference between these two, opening balance and the closing balance, and the depreciation charged on this particular machinery, the balancing figure will be 1,05,000. 1,05,000 is the amount that we are transferring it to the profit and loss. This amount we have to adjust against the funds from operations. Then this is adjustment entry about fixed assets and accumulated depreciation account. Then we have another adjustment for redemption of debentures at rupees 103 of rupees 100 each. So the cost of debenture is 100 rupees each, and we have redeemed it at a cost of rupees 103. So then how many debentures we have redeemed, and what is the profit or loss out of the redemption of debentures we have to see. Let us draw an account for debenture. So the opening balance of debentures is 2,50,000 that was given in the problem, and the closing balance is 1,40,000. It has been said that each debenture cost is 100 rupees. So by dividing this opening balance with 100, we will get that we have debentures of 2,500 in the opening. And when we are dividing the closing balance with 100, we will get the closing balance of 1,400 debentures. That means in opening balance, we have 2,500 debentures, and in the closing, we have 1,400 debentures. So the difference will be 1,100 debentures has been redeemed during the year at a cost of 103 rupees. So at a cost of 103 rupees, we are redeeming the debentures. So opening balance we have made, closing balance we have made, and the amount of debentures redeemed during the year is 1,100 into 103 rupees. That is 1,13,300 value of debentures has been redeemed during the year. Now, when we calculate the difference between the totals, we can see that 3,300 will be loss on the debentures. So we have that means we redeemed debentures at a premium. We have to pay from the profit and loss. So this is an additional amount. So we have to adjust. We have to understand this is a non-operating expenditure. So this expense should be added to the profit earned during the year while calculating the operations from the funds. So this is how we will calculate the debenture account basing on the adjustment given in the problem. Next, we have another adjustment also, that is trade investments account. What the trade investment account is telling that some in trade investments were sold during the year, and the profit that was generated was credited to the capital reserve. Let us see. The opening balance of trade investment is 1,50,000. The closing balance is 1,30,000. And the profit that was generated was transferred to the capital reserve. So what is the profit that we got? The profit is 20,000 rupees. So 20,000 rupees. So now let us draw the account and see how much value of investments were sold during the year. Sold during the year. So opening balance is 1,50,000, and this is the amount, closing balance of the amount, and we transferred an amount of 20,000 to the capital reserve. We changed the amount of 20,000 from the trade investment account to capital reserve account. So out of this total amount, when we deduct this balancing amount, we will understand how much amount of the trade investments were redeemed during the year. So 40,000 value of trade debentures were redeemed during the year. So this is the adjustment that we have to make for the trade investments account. So now that we calculated working capital changes, and now we have calculated adjustment entries for all the non-current assets and liabilities, and then now it is important to know what is the actual funds from the operations. We have to understand the actual funds from the operations. How this has to be calculated. So the net profit that was showing in the balance sheet is the profit that was derived after making all the non-cash expenses and non-fund expenditures. So now, to know what is the actual cash that was generated from the operations, we have to make adjustment for this profit earned during the profit that was shown in the balance sheet. Now let us see. From the sale of investments, you have seen here that in machinery, when we draw a machinery account, we have sold certain amount of machinery during the year. So out of this sale, what happened is that we derived a loss of 14,000. This 14,000 rupees will be deducted from the profit of the year, but it is not a non-recurring expenditure. So we have to add it back to the profit that was earned during the year. So this 14,000 will be added to the profit generated during the year. And on the other hand, depreciation. We calculated the depreciation amount from the accumulated depreciation account. There we are finding that the depreciation is 1,05,000 during the year. This is also a non-cash expenditure, so we have to add this to the net profit during the year. And then again, loss on redemption of debentures. So when we calculated the debentures account, when we draw the debentures account, we came to know that 3,300 has been paid in the form of premium. That is a loss to the company. But this is a non-recurring expenditure, so this we have to add back to the profit to calculate the income from the operations. And what happened is preliminary expenses. Preliminary expenses is also a non-cash expenditure that we will normally be deducted. This was given in the balance sheet. Here it was given in the balance sheet. So we already make adjustments for this. For fixed assets we made, for trade investments we made, debtors, receivables, and banks we made. The other component is preliminary expense. So during the year we have written off 10,000 as preliminary expense. So that also should be added back to the net profit earned during the year. And then, as I already told, that stock has been revalued during the year. So this will not be reflected in the net profit of the company. So whatever the value at which it was revalued, it has to be added back to the profit. And during the year, from the liability side, we can see that we transferred an amount of 30,000 to general reserve, and we have and we made a proposed dividend of 30,000, and we have a provision for taxation. All these are non-cash expenditures. So we have see, when we are mentioning anything as proposed dividend, it can be assumed that we paid the dividend during the year, but actually it will not be paid. It will only paid only once the approval of the shareholder is given. But when it is showing as proposed dividend, we can consider that it has been paid during the year. Here we can see that proposed dividend is 36,000, and unpaid dividend is 4,000. Then, so here in this case, this 40,000, let us assume that it has been paid during the year. We have to assume it like that. So that what we will do is we will add it back to the profit that was earned during the year. So we will add back the general reserve and we will add back the proposed dividend. So the total non-cash or non-fund expenses that were incurred during the year are 2,68,300. This we have to add it back to the net profit that was earned during the year, so that we will get the actual figure of cash that was generated from the operations. Out of this, we have to subtract the any non-operating income. In this case, we did not have any non-operating incomes as such. We did not have got any profits. So that what we will do is that we will deduct it from we will deduct this the opening net profit from this. So that what we will get is we will get the total funds that was generated during the year, total cash that was generated during the year. It includes the actual profit, but we made certain non-cash and non-recurring expenditure. That's why our actual net profit has been declined. But now we made the changes, and now this is the actual cash flows that we have got from the operations. By doing our regular business, we got 3,33,300 as the cash profit. But we made all these adjustments, and then the net profit has become 2,65,000. So to understand this, we are drawing this funds from operations statement. Now with this, we prepared all the basic things that are essential to know the funds from operations. Now that after doing a detailed analysis of each component, fixed assets, current assets, share capital, and then all other outside liabilities, we will understand where the actual cash has been moved. We can see that first, sources. We have sold the fixed assets for cash, that is 35,000. So that is one actual form of cash that we have derived during the year. This actually we cannot understand when we are seeing at the fixed assets component. We don't understand how from where the cash has been incurred. So this is one where the cash has been incurred. And the other one is we have sold the trade investments during the year. So the cost of that investments is 40,000. We prepared a statement for the trade investments. There we can see that we sold the investments for 40,000 rupees. That 20,000 rupees has been transferred to capital. In addition to this, when you look at the share capital composition, the share capital composition also has been increased during the year. It has been increased by 50,000 rupees, the share capital. So it was earlier 4,50,000. Now it was increased to 5 lakh. That means we issued additional share capital. In addition to this, we got funds from operation that we calculated earlier. This is also actual cash profit that we derived during the year. This amount also shows the various forms of cash that was generated in the form of sources. And how we utilized it? We have purchased 2,94,000 rupees worth of fixed assets during the year. And we redeemed 1,13,300 value of debentures during the year. And also we paid dividends during the year. Out of this, we have got an increased amount of working capital. That means we invested working capital also, 11,000. So with this, we will understand that this is the figure of funds flows that were generated during the year. So, but this will not be understood actually. See, what we will see is that when we are looking at the balance sheet, we don't see that these changes in the how these changes has been happened. Now we will understand that various sources of funds, various sources of cash, and how they were invested. This is the example of funds flow statement. So first we have to prepare the changes in the working capital position. Then we have to make adjustments in the current assets and non-current assets liabilities. If there is no adjustments, without any adjustment, if there is an increase or decrease in the non-current assets or liability, it has to be considered as inflow or outflow of cash. For example, let us see. See, for example, here, if there is no adjustment given for fixed assets, let us assume that if there is no fixed adjustment was given. So it was 9 lakhs in the opening area and it was 11 lakhs in the end of the year. So there is nothing mentioned about this. There is no adjustment in this case. Then what we have to do is we have to assume that we have purchased. When there is an increase in the value of asset, it can be considered as purchase. When there was a decrease in the value of asset, we have to consider it as a sale of fixed asset. Whenever there is an adjustment, make an adjustment and try to understand based on the difference whether there is a cash inflow or outflow. This is with respect to adjustment that we need to make for non-current assets and non-current liabilities. Liabilities also same. See, here there was nothing mentioned about share capital. There was no adjustment with respect to the share capital given in the problem. But what we can understand, when the share capital is increased, that means we are getting some additional sources of revenue in the form of share capital. Okay. So with that, we will understand, we will make adjustment to the current non-current assets and non-current liabilities. These points you have to keep in mind. Okay. Is it okay with you? You have an idea now how to prepare a funds flow statement and cash flows, how to prepare a funds flow statement? Are you clear about funds flow statement?
Yes,
Process of
sir.
funds flow.
Clear, sir.
Yeah. Okay. Shall we move to cash flow statement now? We'll go moving for cash flow statement. Okay. Let us have an idea about cash flow statement. Then we'll go for a problem of cash flow statement. See, before going for cash flow analysis, one point we have to understand. What is the difference, major difference between, oh, sorry, I have to share this. So, before going to cash flow analysis, just let us have an idea about what is the basic difference between a cash flow statement and a fund flow statement. See, in funds flow statement, we have seen different sources of funds, different ways of utilizing the cash. We have seen that it has been utilized with respect, which was a broader statement that we prepared. Funds flow statement gives you a broader picture about where the cash has been utilized and where it has, from where the cash has been raised and where it has been utilized. And the cash is a component of current assets. We don't see the total, actually what is the actual cash balance. That was how the changes in the cash balance happen. That funds flow statement cannot give you an idea about the actual changes in the cash that was happened. See, we will have one opening cash balance and we will have another closing cash balance. So the object of cash flow statement is to know specifically about changes in the cash component of the balance sheet. Why there was a change in the opening balance, how the opening balance has changed to the closing balance. What is the changes that was happened? So most of the transactions are similar to funds flow statement, but we will narrow down a better. There it will give you a broad picture of different statements. We made different calculation about different components. But even here we will straight away focus on cash flow component, cash component of the balance sheet. So let us have the fundamentals of cash statement. Normally, this cash financial statements are prepared on accrual basis. Hence, what happens is that the financial statements doesn't depict the actual picture of what was the actual cash flow that was generated during the year. That we have now just now also we have seen that we will enter all non-operating expenditure, non-cash expenses in the profit and loss account, so that the true profit, the actual profit or actual cash profit cannot be calculated. That what we did now is by calculating funds from operation, we try to understand that there. Okay. So a statement prepared to analyze the actual cash flows by making adjustment to the non-cash expenses and non-cash incomes. So now we will try to understand the flow of cash from different segments. We will categorize activities into different segments, and we will try to understand them in different categories. The cash flow statement shows the inflows and outflows of cash from, as I said, that we will categorize the activities that we will not do in the funds flow statement. Now we will categorize those activities and we will see from what activities the cash has been actually. So we are going further deeper into the analysis of cash count. So here we will try to understand the cash inflows and outflows from the operating activities, investing activities, and the financing activities. Normally, the cash component includes cash in hand, cash balance, demand deposit with banks, and cash equivalents like highly liquid short-term investments such as commercial papers and treasury bills. So we will try to understand the inflows and cash flows with respect to these components. So the net cash inflows may be positive, they may be negative inflows. So we will understand by understanding how cash has been from where different sources the cash has been coming and from where different sources it has been utilizing. So that whether we have a normally we will not be having any negative cash balance as such, but it may but sometimes there may be some illiquid assets are there. Because of that, there may be chances of showing negative balance. Okay, we know we will never get a negative cash balance. Cash balance will be there. Some cash balance will always be there. So now try to understand what is meant by cash flow statement. So just as I already mentioned that it specifically focuses about how what is how variations in the cash balance. We will sometimes see that we are incurring large profits, but we don't see any change in the cash balance. Why this is happening? This we can understand with the help of a cash flow statement. By drawing the cash flow statement, we will understand why the cash component is low, irrespective of we are earning higher profits. Cash flow statements helps to make short-term investment decisions. So this cash flow statement helps to make short-term investment decisions. We'll understand the actual cash that is flowing into the company, whether we are getting positive cash flows or we are getting negative cash flows. Based on that, we can take a decision regarding ensuring stability of the liquidity of the stability of working capital position, stability of the company. It provides a snapshot. Working cash flow statement provides a snapshot of all the cash inflows and outflows from financing, operating, and investing activity. These classifications we have not done earlier in the funds flow statement. We are doing this in the cash flow statement. So based on the information that was given in the cash flow statement, we can make some projections also. We can estimate that from where the sources of cashes can be generated in the future. That projections can be made using the cash flow statement. Now let's have an understanding of, as I already mentioned, that what is the difference between a cash flow statement and a fund flow statement. Now let us try to understand a little bit. So cash flow analysis is based on cash concept, but the funds flow statement is based on the working capital concept. There we will take all components of current assets. In cash flow, we will focus only on the cash component. And in the cash flow analysis, the analysis is based on actual realization of the cash. And in the funds flow analysis, we are focusing on the accrual concept. The funds flow analysis is based on accrual principles. Cash flow statement shows changes in the movement of cash from operating, financing, and investing activity. Funds flow statement shows movement of cash in relation to the changes in the working capital position. So, based on the changes with respect to the working capital position only, we can understand the movement of cash, but it doesn't give the actual picture of the cash, how it is being varying. In cash flow statement, we will understand how the cash balance is varying. Using cash flow analysis, we can focus on short-term solvency of the. We can understand what is the short-term solvency of the firm. Short-term solvency of the firm. We can take a you can take a decision regarding fulfilling the liquidity obligation. Fund flow analysis will give you a long-term perspective. We can understand the long-term solvency of the firm. Because it will give the selling and purchasing of assets, so that you can utilize the information based on the funds flow statement for determining the long-term solvency of the funds. Cash flow analysis has relation to the changes in the as fund flow statement, but the fund flow statement cannot be affected by the changes in the cash position. See, we know that we are deriving this cash flow statement based on the information that is derived from the funds flow analysis. So certainly the changes in the funds flows can be affected by the cash flows, but the changes in the cash flow position will not as such affects the funds flow statement analysis. So the concept of funds cash flow is much more broader than funds flow analysis. We are going to look at in a micro level of cash position in the company. And one of the important things with respect to cash flow statement is that it is a statutory obligation. We have to follow this preparation of cash flow statement as a statutory obligation because understanding the changes in the cash component is very much essential. It will give you a broad picture of how the cash has been generating and how the cash has been moving. So the accounting standard 3 given by the ICAI will define the purpose of a cash flow statement, and it will also give you an idea about what are various cash flows and what are various types of cash flows, how we have to consider cash flows, and how we have to differentiate the cash flows from different activities. So as per the Indian Accounting Standard 3, all the cash flows can be, whether it can be inflows or outflows, can be categorized into three forms. That is investing. Investing means where we are putting the money. We got the money and where we are utilizing the money. So the activities that we are doing for investment purposes are classified as investment activities, and some of them are sale of assets, purchase of assets, or sale of investments, or purchase of investments. Financing activities. Financing activities are related to uh, Financing activities are related to issue of shares, other securities, raising of long-term loans, repayment of long-term loans. And cash flow statement can be this is the three categories of cash flows that can be categorized based on the guidelines given in the cash flow statement. So a cash flow statement can be prepared according to the guidelines given in the accounting standard 3. It can be prepared using indirect approach. What is an indirect approach and what is a direct approach? Under indirect approach, we will take the profit earned during the net profit earned during the year after making adjustments for uh, provision for taxation and dividends. So we will make changes. We will make the changes to the net profit by calculating the operating cash flows and investing cash flows and financial cash flows. But under direct approach, what we will do is we will not take the net profit. Instead, what we will do is we will take the activities directly. So we will not take any differences. We will take what is the actual cash generated from different sources, and we will try to take difference in the component. And then that component can be added to the net profit, can be calculated to the net profit. But as far as Indian Accounting Standard 3 is concerned, we have to prepare using it the indirect method. That means we have to take the net profit earned during the year and we have to make adjustments to the net profit during the year. So according to the Accounting Standard 3, this is the format given for calculating the funds flow statement. So first we have to calculate cash flows from the operating activities. Here we will add all the non-operating expenses and incomes as what we will do in calculating funds from operations. And then we will make adjustments for working capital changes. And then we will make changes for any other extraordinary items like dividends paid or any other taxes paid during the year. So by making adjustments to this, we will understand what is the operating profit of cash from operating activities. These are the components of calculating cash from operating activities. Depreciation, loss on fixed assets, foreign exchange, miscellaneous expenditures, written off, investment income, interest, dividends. All these are non-operating and non-cash expenses. The second component is cash flow from investment. So investment means we are making investments in fixed assets, or we are selling off the fixed assets, or we are purchasing the investment, or we are selling the investments. We may be receiving interest on the investments, or we may be receiving dividends on the investment. All these will be categorized under the investment activities. And the other so out of this we may see that cash inflow or outflow. If there are more investment activities, then there will be negative. That means cash flow out, negative outflow. Cash outflow will be there. And the next component is cash flow from financing activities. So financing activities means from where we are raising the capital. So we may raise the capital or we may redeem the capital. So what are various sources of financing activities are? Proceeds from the issue of share capital, proceeds from long-term borrowings in banks, payment of long-term borrowings, dividends paid during the year. So all these will be covered under the financing activity. So we may get we may get cash inflows or outflows from operations, or we may get cash inflows or outflows from the investing activities. We may get cash inflows or outflows from the financing activities. So after taking all these things from investing, operating, investing, and financing, we will understand what is the actual cash component earned or decreased during the year. So decreased during the year. So for this, we will add the opening balance. So once we add the opening balance, so we will get the what is the actual cash balance that was at the end of the financial year. So for the opening cash balance, we will add the cash that was generated from all these activities so that we will get the cash balance at the end of the year. So here we are not doing any we are not doing we are taking the same components what we are taking in the funds flow analysis, but we are specifically focusing on the cash component. But in funds flow statement, we are focusing on the working capital. Working capital includes cash plus other components. Here we are specifically looking at the cash component. So when we compare funds flow statement and cash flow statement, we have to look at the changes in the working capital position. Say for example, the changes in the working capital is some 1 lakh rupees. So how much amount of cash has been changed? That we will understand by preparing the cash flow statement. So that difference we have to understand from the cash flow analysis. So just have an idea about the fund. Just have an idea about various sources of cash that will be generated from operating, investing, and financing and cash equivalents. See, this is the list of operating activities from where the actual cash will be generated during the year. We will get cash revenue from operations. We will get cash received from trade receivables. We will get trade commission. Cash purchases will be there where we have to pay the cash. All our cash, other than credit, what that was done in the form of cash, will be covered in the cash flow statement. So any employee benefits paid or any other office and administrative expenses, sometimes we may not paying the cash. We will show it as under accrual basis. We may not be considered as paying cash, but when we paid but in the cash flow statement, we will calculate the actual flow of cash with respect to this following transaction. These following transactions may be in the credit form also, that can be reflected in the funds flow statement. But here we are looking specifically on the cash component. We will understand the movement of cash. So these are various components of operating revenues that can be generated. Manufacturing overheads paid, selling and distribution expenses, income tax paid, rent paid. So these are all operating activities that will show cash inflow or outflow. On the other hand, investing activity. Purchase of machinery, it's a cash outflow. Proceeds from the sale of old machinery, it's a cash inflow. Purchase of non-current investments, cash outflow. Proceeds from the sale of non-current investments, that is a cash inflow. Purchase of goodwill, proceeds from sale of payments. Interest received on debentures held as investments. You will receive investments, interest on debentures held as investments. Dividend received on shares held as investments, and rent received on property held as investment. All these activities are investing in the nature means that we will that by making an investment, we will try to expect some benefit out of that investment. So these may not be the regular activities of the business. Some investment activities like investing in debentures and shares may not be the regular activities, but purchase of machinery, sale of machinery, purchase of land and building, all these will be under the investing activities because they are essential to carry out the regular business operations of the company. So whatever the act, these are all fixed assets or fixed investments or short-term investments that will have a benefit for a period of more than 1 year or maybe benefited for less than 1 year. So short-term, both short-term and long-term will be covered. And then the sources of financing it. Financing activities are from where we are raising the funds. Whether we are raising the funds from shareholders or we are raising the from the outside. So what we are paying on the finances that we received from the outsiders onto the shareholders that are considered under financing activities. So what are financing activities? Let us see. We can get cash in the form of issue of equity shares. We can get cash by raising long-term borrowings. So the finances we can pay the cash in the form of redemption of preference shares. Sometimes will pay the dividend on the equity shares. We have to pay interest on the long-term borrowings. We have to pay dividend on the preference shares. Sometimes when you are going for some issue of shares, we have to pay the underwriting commission. Sometimes we have to pay the brokerage on the non-current. We have to pay brokerage is underwriting commission and brokerage may be mostly similar. And a bank overdraft is also a source of financing activity we will get from the bank because the relationship that we are maintaining with the bank. So these are the three categories of activities through which the cash inflows and outflows will be happening. So basically the cash flow statement is prepared by taking these three components into consideration. Apart from this, we will have some cash equivalents which can be easily converted or quickly converted into cash. These are also a part of cash components. The cash components, we will while we are taking the cash component in the balance sheet, we will take all these components into consideration. That is cash credit, short-term deposit, marketable securities, refund of income tax receipt. So this is about cash flow statement. These are the basics about a cash flow statement and how we have to prepare the cash flow statement. So what are the guidelines? So we have to follow the guidelines that were given under the accounting standard 3 and we have to classify the activities as per the guidelines given in the accounting standard 3. And then we have to prepare this format. See, here also we have to make adjustments for the non-current assets. We have to make that adjustments and we have to see. And then we have to for each item given in the balance sheet so that we will understand the movement of cash inflows and outflows. Let us see this with an example. We will try to understand the process of preparing a cash flow statement using a problem. So I will discuss a problem with you regarding cash flow. See, in the cash flow statement, we are not looking at the changes in the working capital position. Straight away, we are going to the analysis of cash flow statement, analysis of changes in the cash balance of the company. So here we have given a problem. This is I am taking a small example to understand how we have to calculate the changes in the cash flow. See, here in the balance sheet, we can see that this cash equivalents. Here it is 3 lakhs, here it is 4,70,000. So how these changes happen? How the cash component has increased to 4,70,000. So that we will study using the cash flow analysis. Here also some adjustments will be given with respect to non-current assets and non-current liability. Same adjustment. However, whatever adjustment we will do in the funds flow statement, we will do the same adjustments here also. The only difference is that we are not taking, we are taking all the components at a time. We are not taking any separate working capital thing. We are straight away looking at the cash component. We are not focusing on current assets and current liabilities position. That changes also we are straight away taking into the calculation of a cash flow statement. We are not making any specific understanding about the working capital. The working capital, the changes in the working capitals will also be straight away taken to the profit and loss account. Sorry, we will take into the cash flow statement. Here we have given an adjustment for the machinery. Let us see here. Uh, we have a machinery costing 5 lakhs rupees, and the same machinery was costing 6 lakh 60,000 rupees at the end of the year. So during the year, we charged a depreciation of 40,000 on this machinery. So we have to prepare a account for this machinery, and then we have to understand whether there is any purchase or sale of machinery happened during the year. So we have to enter first the opening balance, that is 5 lakhs rupees, and then we have to enter the closing balance, that is 6 lakhs 60,000 rupees. So depreciation, we charged a depreciation of 40,000 rupees on the machinery. The depreciation can be transferred to the profit and loss account. This is a non-cash expenses. This we will make an adjustment to this will be made in the cash flow statement again. So here the total is on the left hand side is 7 lakhs, and the the balancing figure can be a purchase of machine. So it is a cash outflow. So by drawing the machinery account, we understand that there was a cash outflow in case of machinery account. So is there any no other? We don't have any other adjustments, and we don't have any other fixed assets also in the problem. So what we can do is that we can next straight away go to the calculation of cash flow statement. If there are any other adjustments, like for example, if there is another, see for example, if we have any other fixed asset like land and building, we don't have any adjustment. So for example, here it is 1 lakh, and it may go to 2 lakhs rupees. But there is no any adjustment given in the problem. Then what we have to see that there was an increase in the value of land and building. That means it will indicate that there was a cash purchase. We are purchasing more land and building. When it was declined, we can see it as it is 50,000. We can see it as a decline in the value of land and building. That means we are selling of the land and building. That means there is a source of cash in the form of land and building. But we don't have an adjustment here, but we are not taking it. When there is any adjustment like depreciation, what we have done, we have to do that, and we have to find out whether there was a purchase or whether there was a sale in terms of long-term assets or long-term liability. Here, as there is no any other adjustment for the fixed assets, we can straight away go to the preparation of cash flow statement. So, while calculating the cash flow statement, we have to see the profit earned before taxation and any other extraordinary items. So, we have to take the uh, profit after adding back the any tax component, or after adding back any dividends that were paid during the year, for the purpose of uh, because to know the actual cash that was generated from the operations, we will be adding back this to the net profit earned during the year. See here in this example, we did not given any profit and loss account balance. So we did not given any net profit or dividend paid or any provision for taxation, or any such information is not given. If we were given, say for example here also, if the profit and loss account balance, if the profit and loss account balance, profit and loss account balance, and provision for depreciation, provision for taxation, and dividends, proposed dividends are given. In this case, in this case, if for example it is 1,000. Just I am telling it as an example to understand. 1,000 and some 3,000 and some 4,000 and some 3,000. So here to calculate this net profit before taxation and extraordinary items, this amount we will take, and for this amount we will add this provision for taxation and proposed dividend. So this total amount will be taken in the cash flow statement for the purpose of calculating cash from operations. Why we are adding back this is we will trying to estimate based on the actual profit generated from the operation. That's why we are adding back this provision for taxation and dividends. But now here in this problem, these components are not given. So when these components are given in the problem, you understand this. So we have to take profit and loss account balance, and then we have to add these two components. Here, otherwise, what happened if these are not given? If these are not given, then we have to look at the reserves and surplus. So here in this problem, we have given the reserves and surplus. So by looking at the reserves and surplus, we can see that when we take the difference between opening and closing balance of reserves and surplus, normally the profit that was generated during the year will be transferred to reserves and surplus, or it may be shown as separate. Here in this problem, it was shown as a component of reserves and surplus. As they have not given the profit and loss account information, we can consider reserves and surplus as a component of profit and loss. Hence, the difference between opening and closing balance of reserves and surplus will gives you the profit earned during the year. So this may this is after tax only, but we don't have any tax information. Or it may be after payment of dividends also. It may be after the payments of dividends also. So we don't have any such information. So what we will do is we will take this amount straight away into the calculation of cash flow statement. So this point you have to understand. Then, then first component what we have to do is we have to calculate cash from the operating cash flows, operating activities. We have seen different type of operating activities. See, there are different type of operating activities. So the revenues can be generated from this type of activities, and the revenues can be paid from this expenses can be paid for this only for this operating activity. Other than this, if there is any revenues or if there is any expenditures incurred, that we have to add back or we have to subtract. If you are adding any non-operating, if you are directing any non-cash expenditure, we have to add it back. We are deducting any non-cash expenditure that we have to add back. Let us see. So depreciation on plant. In this problem, we have depreciation on the plant as 40,000 rupees. So this is a non-cash expenditure that we will be normally deducting from the profit. So we have to add this back to the profit earned during the year. That is 1,30,000. We have to add this amount to the 1,30,000. Other than this, we will be having other non-cash expenditures also. Here we only have only few things. If with only one item we have, only depreciation of the plant we have. So we also have to make changes in the working capital position. We did not make these changes in the funds from operation that we calculated there. Instead we have done we have developed a statement of changes in the working capital position. Here what we will do is that any changes in the current assets or current liability that will be affected in that will have an effect on the revenues of the company has to be adjusted. See, for example, trade receivables. When there is an increase in the trade receivable, what it indicates? The increase in the trade receivables indicates that there was an increase in the revenue, but there is no actual cash flow, right? But this will be reflected in the revenues of the company, but there is no actual cash flows from the trade receivables. So this is a credit transaction. So we have to deduct this amount from the increase in the current assets, specifically stock or trade receivable. When stock or trade receivables increases, we have to add that amount back to the net profit. Why? Because we are there is no any actual cash flow, but we are considering it as an actual cash flow. We have to add it back to the net profit earned during the year. Okay. Here we see the trade receivables decline. So current this was a decline in the value of trade receivables. When trade receivables are declined, what it will shows that we have received a cash. So earlier what happens is when trade receivables are increased, that means credit transactions are increased. That time we will deduct it. Here the trade receivables has been declined. That means we have received a cash component. That's why we will be adding this 50,000 as a cash component to this 1,30,000. And the stock has been increased. Stock has been increased. The increasing the stock value will increases the revenue component of the company. So this is a non-cash. So when we are calculating the revenue, total revenues of the company, it shows the non-cash component of the company. So the increase in the stock can be declined from the revenues. And at the same time, decline in the trade payable. Decline in the trade payable shows that we are paying the certain amount in the form of cash. So we have to deduct it from the revenues that were earned during the year. Okay. So from this, what we can see is that we have added back non-cash expenditure of depreciation of 40,000, but and at the same time the decrease of receivables where we received the cash is added back, but increase in the stock and decrease in the trade payable shows that there was a cash outflows from the operation. So when we make an adjustment to the net profit during the year, we can derive negative cash flows from operation. That is cash outflows. Here we have a outflow from the operation, outflow from the operational activity. And when we look at the investing activities, during the year we made only one investing activity. That is, we purchased a machinery. So it is a cash outflow. So that's why we are showing it. So what are the cash flows from investing activities is 2 lakhs outflow. 2 lakhs is the outflow of outflow from the investing activity. And cash flow from financing activities. What are the financing activities like? Only one equity share capital is there. During the year, the share capital component has been changed from rupees 20 lakhs to rupees 25 lakhs. That means we issued 5 lakhs rupees during the year. That is a cash inflow. So from the financing activities, we can see that there was an inflow of cash in the form of issue of shares. So cash flow from the financing activities is 5 lakhs. So now there was a cash outflow from operating activities. There was a cash outflow from the investing activities, and there was a cash flow inflow from the financing activities. When we add these together, we can see that from financing activities, we received 5 lakhs rupees, but we have to adjust it against the purchase of machinery, and then we have to compensate with the loss that was generated from the operations. So that what happens is, after making the adjustment to these 2 lakhs, purchase of machinery and from loss from the operations, the total net cash that was increased during the year from these three activities, that is from operating activities, financing and investing activities, is 1,70,000. That means this 5 lakhs minus 2 lakhs and this 1,30,000 will gives you the actual cash flows that were generated, cash inflows. If it is negative, then it is a cash outflow. And when we add back the profit cash that was at the beginning of the year to this cash generated during the year, we will get the cash flow that was generated, the cash flow balance at the end of the year. At the end of the year, that is 4,70,000. Here, the cash flow balance is 4,70,000. So, initially we have a cash of 3 lakhs rupees, and at the end of the year, we have a cash balance of 4,70,000 rupees. How we got this 4,70,000 rupees? So, when after preparing the cash flow statement, we understand that from operations, we derived a negative cash flows, negative cash outflow. That means the revenues that were generated during the year are not sufficient. So, apart from adding the non-cash expenses also like that, depreciation on plant and trade receivables. So, due to increase in the stock value, that means the more stock is in the more stock. There was an increase in the stock, means there was less liquidity with respect to the stock. But The stock component will be added in the calculation of revenue. So as a result of this, and as a result of trade payables also, we paid more trade payables, right? Trade payables are the short-term obligations that we have to pay during the period. So with respect to working capital, we have a problem. We have incurred some cash expenses. That's why we got a negative cash out. So after considering with the revenue that was derived during the year, we got 1,30,000 as a negative cash flow from the operation. And machinery is a straightaway investing activity. So there was a straightaway cash outflow, that is 2 lakhs rupees. And then 5 lakhs we have received from the share cash. So these are different sources of cash outflows and inflows, actual cash outflows and inflows, and this is the cash balance that we got at the end of the year. So as we have seen that this will give us an idea about where we are investing, where we are getting the cash, actual cash. Right? See, in funds flow statement, we got working capital balance. Here we got the cash balance. That is the major difference between these two activities, these two statements. So these two tools will help you to understand what is the uh, actual movement of funds or cash in a business. So this understanding is essential as a part of financial statement analysis. See, yesterday and today we have learned all these tools. We have learned comparative financial statement. We learned common size financial statement. We have gone through trend analysis. We have gone through, we have gone through ratio analysis, and now funds flow and cash flow. So each one has an individual necessity, individual requirement. So each one has an individual object. So while analyzing the financial statement, we have to take information from each component. Based on based on making a comparison between each item or each tool that we have generated, we can take a decision. Mostly the objective is to take a future-oriented decision. So this analysis should be helpful in making future-oriented decision-making process. So, do you have any doubts regarding cash flow statement? Are you okay with the cash flow statement analysis? Okay with the cash flow statement analysis? See, these formats you don't forget. Please keep in your mind. Uh, whatever the formats I've shown you, one time let us see these formats. Very important to keep these formats. Have an idea about. You have to do a lot of practice for all these problems. Mostly for ratio analysis, you should do a lot of practice. See these state formats. Once you understand this format, it will be easy for doing the problem. You just go through these formats, you understand these formats for working capital statement or for preparing the funds from operation statement or funds flow statement. So if you have this idea, you will understand what are the items we can take. We may be confusing. See, when we are looking at adjustments and when we are looking at the balance sheet, so we will get confused which items we have to take, how to take, what to take. So if there is a picture of these items in your mind, then you can understand and go in the order of items given in the balance sheet. First, go through assets wise, or then go through liabilities, so that we will understand where we what for which item we have an adjustment, for which item we don't have an adjustment, so that we will have an idea when immediately when the problem is given, we will have an idea where we have to do the adjustments and where we can go directly with the information given in the balance sheet. So keep this an idea about all these points, all these three formats for funds flow statement. And for cash flow statement, this is a contents given in the accounting standards 3. So this you have to follow as it is, exactly similar like funds flow statement. These items you have to keep in mind. And you have an idea about all these components from where the actual cashes can be. These items may be in the form of non-cash also. These items can be in the form of cash also. But Here we are considering it from the cash perspective. Any doubts, please? Any doubts? Everything is okay?
Sir.
Right. Thank you. Thank you. See, I'm also sharing the PPT. Someone asked for PPT. I'm sharing the PPT also. Okay. Sharing the PPT also. Yeah. I'm sharing the PPT also. If no one wants, you can take the PPT.